understanding the implied volatility of the stocks you choose to trade, particularly if you are going to trade options on those stocks, is vitally important. I have a chart here of BSX, Boston Scientific, which just happens to be on our options and stock report lately. And this is a chart with a couple of implied volatility indicators. The bottom one, the blue one, is the default implied volatility indicator. You can just add that to the chart. You can go up these little beakers here and or that one there and add those studies to the chart. Just boom, pop it open. I can just start searching for the letters there, and there it is, implied volatility. Add it to the chart. Boom, you're good to go. Now, this indicator tracks and measures the average implied volatility of the options. And simply put, when the expectation of implied volatility is high, that means that the market's expecting prices to move. And that typically will mean that the options are priced higher to anticipate those moves. So implied volatility is a future-looking forecast of what they expect volatility to be. Historic volatility is a measure of the past volatility. Implied volatility is a measure of the expectation or the implication of volatility. And if you look at this indicator, sometimes you'll see implied volatility go really high. You'll typically see that right around earnings. The expectation that price could change suddenly on earnings, you'll see the implied volatility rise, and that means the options will be expensive and they wouldn't be a great value to buy. And on the flip side here, you can see right now that the implied volatility is on the very low end of the indicator, which means that the average implied volatility is low, meaning that the options on this stock would be quite affordable. Now, this top indicator is a custom indicator, a proprietary indicator that we've been using here over at Tackle Trading. And it gives us the same implied volatility measurement, but it also tells us whether it's high or low compared to recent history. So I can look at this implied volatility and see that, hey, the IV rank is currently at 33% of the past year's high and low volatility. The IV percentile, 23% of the days over the past year were below the current IV. So that means that 77% of the days had higher implied volatility. Oh, and look, there comes earnings. Earnings is out here on the calendar, and I know that implied volatility tends to rise at around earnings. So now I could say, well, implied volatility is on the lower end. Only 23% of the days were lower, and earnings is coming. Well, that means I could probably realistically expect volatility to rise and be there in line with the other 77% of the days. And again, typically increased and above average around earnings. And so you can also see the implied volatility when you're on the trade tab and you go over here. You can look at the layouts here and it can show you the probability implied volatility. You can put that layout on the chart and it'll show you the implied volatility measurement. It'll give you the specific measurement per strike price. And you'll see it on both sides for calls and puts. And, you know, on average, you'll see that implied volatility measurement give you an estimate of percentage. And it's an annualized number, but it's based off of the number of days. You know, 39 days, they're pricing in 39 days, but they're looking at a 24% volatility over a year. And so it's kind of taking that 39 days until expiration or 130 days. And again, that measurement of implied volatility, that expectation for the stock for the year, and it's helping you determine what the option premium ought to be based off of the risk of the underlying asset. If it's more volatile, premiums go up. If it's less volatile, premiums go down. And because you hang out with us over here at Tackle Trading and you watch all these videos and you go through the step training like you do, you now have a really good understanding of implied volatility. Use it well. Buy options when implied volatility is cheap. Sell options when implied volatility is high.